Addressing maturity gaps. Strategies for managing liquidity risk. Liquidity risk is an important consideration for any business, especially for financial institutions. It refers to the potential for an institution to be unable to meet its financial obligations when they come due. Managing liquidity risk effectively requires identifying and addressing maturity gaps, the mismatches between the maturity of assets and liabilities. 1. Asset-Liability Management, ALM. ALM is a comprehensive approach to managing liquidity risk. It involves monitoring and controlling the composition, maturities, and interest rate sensitivity of assets and liabilities. By aligning the timing and interest rate risk of assets and liabilities, ALM minimizes exposure to liquidity risk. 2. Cash flow projections. Regularly forecasting and projecting cash flows is crucial for identifying liquidity gaps. This allows businesses to anticipate any shortfalls or surpluses in liquidity and take proactive measures. Effective cash flow projections include considerations for market conditions, interest rates, and potential scenarios. 3. Diversification of funding sources. Relying on a single funding source poses significant liquidity risk. To mitigate this risk, businesses should diversify their funding sources. By obtaining funding from multiple sources such as equity, debt instruments, and lines of credit, companies can reduce their vulnerability to disruptions in any one funding avenue. 4. Maintaining adequate liquidity cushion. Having a sufficient liquidity cushion is vital in managing liquidity risk. It provides a buffer to meet unexpected cash flow demands. Businesses should determine an optimal level of liquidity based on their specific needs and financial situation. This cushion can be maintained through various means, such as maintaining cash reserves or easily accessible credit lines. 5. Stress testing. Conducting stress tests helps assess the impact of adverse events on liquidity. By simulating scenarios such as economic downturns, sudden market disruptions, or changes in interest rates, businesses can identify vulnerabilities and develop contingency plans accordingly. Stress testing enhances preparedness and responsiveness to potential liquidity shocks. 6. Continuous monitoring and reporting. Regular monitoring of liquidity positions is crucial for timely identification of potential liquidity risks. Businesses should establish robust reporting mechanisms to track liquidity metrics, such as cash flow ratios, funding concentrations, and liquidity gaps. This enables proactive management of liquidity risk and facilitates informed decision-making. 7. Establishing contingency funding plans. Contingency funding plans outline actions to be taken in response to liquidity stress events. These plans define specific steps to access additional liquidity during periods of financial strain. By having well-defined contingency plans in place, businesses can swiftly respond to liquidity challenges, ensuring the smooth functioning of operations. Managing liquidity risk effectively is vital to ensure the stability and sustainability of any business. By implementing these strategies, businesses can proactively address maturity gaps and reduce their exposure to liquidity risk. Want to learn more? Claire Trifle on LinkedIn.